Hey everybody, Marty Mazur, good morning, 20th of February 2016. Let's take a look at the charts. Here's my 60-day, 60-minute charts. I want to get rid of this because I want to recreate it for you. Okay, so last time we looked at this was a week ago Thursday, the 11th. I told you the market was way oversold and that we might see a short-term bounce. And my did we ever. We had 3 consecutive days of over 1% up moves in the S&P 500. First time we've seen that since October of 2011. Then we created a new channel here, a new upcycle. Found resistance right there, came off of that, had a flat day yesterday. So again, now we have this new up channel, at least for the moment, to look at. Let's take a look at how the trading has been against the Fibonacci retracement lines here. We've done this before. You may recall when we did this, I showed you how first of all, you start at the top, you come back to the entire declining cycle, and then, so here's where we bottomed on January 20th. It supported that pound support there twice, and then came off of that. Came up. Now the key levels that technicians seem to talk about the most are the 38, 50, and 62% retracement levels, retracing our way back to the top. And as you can see, we came through the 24, actually found support there, found resistance at the 38, finally broke through that, and then found strong resistance right here. Bumped up against it twice and then completely failed and created a new down cycle and came all the way right back down to where it bottomed before. Tested it 3 times, came through it, but I would say passed it, and then shot higher as we explained. Notice how we got through, or as I explained, we got through the 38% retracement level, and then came back down and it became support 1, 2, 3 times, broke down below it, but then fought its way back and ended above that. I would say that if someone wanted to be optimistic, that was a pretty good, strong technical signal yesterday against really a real falling or a real decline in oil prices, 3+%, and a pretty hot CPI number. Doesn't mean that we won't fail that and come back down noticeably, but I would tell you that was a pretty strong signal. And what technicians are really looking for right now is 1950, which is just above that 50% retracement level. If what I heard one say is that if we can get above 1950 and hold that, then we're going to move higher and test, maybe even come back up and test this, this 2080, which was the peak. Folks, as I keep saying, we'll get there. I can virtually assure you, I can't guarantee anything, but we will get there. It's just the timing of that, remains to be seen. I've been continuing to make the case that when you look at when years have started like this in the past, this big downdraft, that we don't end here, or that we don't bottom here, that it goes lower before it gets higher. Absolutely does not have to happen that way. If it does, it certainly wouldn't be a bad thing for patient long-term investors, but we'll certainly talk about it as things develop. I mentioned that this was the last time we had 3 days like this since October 2011. So let's go ahead and see what that looks like and kind of zero in on that period. So that would be right. That's interesting. Let me just do this. This might be easier. Okay. That ought to work. Okay. So that would be right in here. Notice the similarities to the chart we've been looking at. You can see the big decline. You can see the market battling off. Maybe I'll draw those retracement lines and see what happened. Came back down below that, found some new support. Came back up. Well, those 3 days were in here, folks, and as you can see, it did not signal the next new big rally in stocks. That happened later. That came late November, where we finally bottomed here. And although I actually did bottom here for the last time, it came down to this level and then shot its way higher. Let's just for fun take a second and draw that retracement area. Probably, yeah, we'll just go back to here. I could go back to this one, but let's just look at this one. So we'll go here, trace that decline, and then see where we found resistance. You notice, so again, here's the 50%, came back up, just could not hold above that 50% retracement. Today, that would be the 1950. Couldn't hold it, came back down, gave a valiant effort again, could not hold it. That just was too strong a resistance, came all the way back down through that bottom. You can see it tried to hold that bottom there for a day and then couldn't. Came back down, bottomed, and then came shooting higher up through, struggled with the 50, then finally got above it, and this was that whole 3 days. So that was pretty encouraging. I imagine people got above this, and you saw some pretty strong technical buying, but then it failed there. Came back down, found that bottom, and then set the stage for a really nice couple of years. The 2012, our portfolios did very nicely, and 2013 was just ridiculous to the upside. You might be wondering, let me get rid of that. You might be wondering what these orange and yellow lines are. These are moving averages, very important indicators to technicians. The orange is the 50-day moving average. What it is the sum of the last 50 closing prices of the day added together and then divided by 50. So you get the average, and then each day you do the prior 50. So that's the moving average. This is the 200-day moving average. If you want the market to go up, you want the 50-day to stay above the 200-day. That shows momentum, near-term momentum in the market relative to what's been happening longer term. When the 50 drops below the 200 days, that can be so ominous that technicians call it the death cross. When it goes up, they call it the golden cross. A very poor indicator by name, because many, many times that happens and the market doesn't die, but it can go through some pretty noticeable corrections. This was the last really good correction we had. It was actually 19% if you go back to the peak where the market peaked down to the bottom. So we have a ways to go if we're going to match 2011. But as you can see, the market fought its way back. The technicals got very strong, and good things tend to happen when the 50-day is above the 200-day. Now you bring that back up to the present day, and what you'll see is a similar looking chart again to 2011. So this is a 1-year chart, and as you can see right here, the 50 broke below the 200, and there we have our decline. If you go back a little further, you can see it happened back in August, when we had that correction that I said didn't really count. It was disappointing in my view, because the market just came bouncing back and we didn't get to do any of that weed pulling. And so the market came back. Actually, I would imagine that right there, people got very optimistic because the 200-day went above the 50-day. I'm sorry, the 50-day went above the 200-day, but then it came back down. The current slope is not a it's not going to give it to us. The current look at the trajectory of the 50-day, this would not be positive. The fact that it hasn't even begun to turn up at all at this point, that would support, at least technically, my notion that we could very easily go further, down, and that this particular rally may not hold. None of this has to happen, folks. I just showed you an instance earlier where the 50-day came above the 200-day, and I'm sure people were throwing a party, but it quickly turned in the opposite direction. There are so many factors impacting the market other than just these technicals, but the technicals do give us a real sign of what's going on in the outside world. So folks, I think I can just leave it there with this. And I say this, I think, every time. When I show you this stuff, it's really just to give you a bit more insight into the internal workings of the market. I think the more we understand the factors that can push it around on a near-term basis, I think the more comfortable we can be with it. I think the notion of just sitting out there and thinking this market is crazy and just doesn't make sense can engender nervousness. Even for the long-term investors who think in terms of the fact that they own good companies, it can be bothersome when the prices of these good companies are just getting, pushed around like there's no tomorrow. So understanding some of the technicals and what some of the players are doing that causes that volatility, I think, is a good thing. You'll let me know if it's not, and I'll leave it there. Thanks as always for watching, reading, and listening, and have a wonderful weekend. I'll be back next week.